Your ultimate pit stop, Piston Pundit. Over the past month, Wall Street's financial engine has backfired twice. First, a $25 billion Treasury auction imploded, then Trump-era tariffs on Chinese imports were slashed without warning. Both shocks sent benchmark yields and market tremors racing through global economies. And nowhere is the impact more immediate than in the automotive world. From escalating loan rates that inflate your monthly payment to chaotic duty reversals disrupting supply chains, this financial perfect storm is rewriting the rulebook on how you buy, build, and power your next vehicle. Strap in. Here are the 4 critical deep dives showing how debt, duties, and scarce minerals are reshaping the driving landscape. Number 4, market mayhem, loan rates surge, and financing fallout. When the Treasury failed to place 41% of its 30-year bonds on May 9th, yields spiked to 4.82%, their highest mark in months. Auto loans, which track Treasury benchmarks, immediately felt the aftershock. Lenders pass on their increased borrowing costs by raising APRs on vehicle financings. Picture this. You're eyeing that $40,000 electric SUV, but the financing rate just climbed 0.5%. Over a 60-month loan, that upswing adds nearly $1,200 in extra interest. Captive finance arms, Ford Credit, GM Financial, Stellantis Financial, are already recalibrating incentive programs. 0% offers are vanishing, cashback rebates are shrinking, and flat payment deals are on life support. Meanwhile, OEMs tapping bond markets to fund factory expansions or R&D in autonomous and green technologies now face pricier debt servicing, slowing new model rollouts. Used vehicle residuals, which had surged during the pandemic, are also softening as buyers anticipate cooling prices, pushing up lease extension and buyout costs. In real terms, today's bond market maelstrom isn't abstract Wall Street jargon. It's a measurable hit to your wallet, whether you're financing a brand new ride, leasing, or watching from the sidelines as automakers navigate tighter capital conditions. But loan rate spikes aren't the only shockwave. Next up, duties are flipping entire supply chains on their head. Number 3, duty shockwave, tariff reversal throws supply chains into turmoil. Just 3 days after the auction fiasco, the White House stunned markets by chopping Chinese goods levies from 145% to 80%. No phased negotiations, no grace period. Key auto-grade inputs, high-strength steel, aluminum alloys, precision sensors, electronics modules, were caught in the crossfire. Overnight, importers saw punitive duties slashed by 65%, but still faced an 80% surcharge, upending procurement plans at lightning speed. Supply chain teams scrambled to reroute shipments through intermediate ports in Vietnam and Thailand to sidestep the steepest penalties. But those detours add days in transit and extra handling fees, costs that inevitably trickle down to your final invoice. Dealers in tariff-sensitive regions report buyers hitting the pause button, wagering on further cuts or a full repeal. Cox Automotive data shows that every 10% swing in average duties can adjust transaction prices by over $350, enough to sway family budgets or high-end luxury purchases. Aftermarket and DIY communities aren't spared. Even at 80%, replacement modules, turbocharger actuators, advanced driver assist radars, bespoke suspension components can still cost nearly double their pre-tariff MSRP. For enthusiasts and independent service shops, that means steeper maintenance bills and longer wait times for critical parts. In short, this duty whiplash is no mere policy footnote. It's a live wire jolting every link in the auto manufacturing and retail chain. Before we delve deeper, do us a favor and smash that like and subscribe button. This helps us reach more auto enthusiasts just like you. Ready for the next curve? Let's rev into mineral markets. Number 2, mineral market mayhem. Rare earth squeeze threatens EV rollout. Beneath every electric vehicle lies a battleground of rare earth metals and battery minerals, and China's export controls are tightening that chokehold. In April, gallium and germanium shipments fell 16% year over year, while neodymium prices have surged over 28% in 6 months. These elements power high-performance magnets and next-gen semiconductors in EV drivetrains. Major automakers accelerating all-electric transitions, GM with its Ultium cells, Toyota's solid-state prototypes, Ford's F-150 Lightning, now face a raw material scramble. Battery suppliers like CATL and LG Energy Solution are locking in multi-year contracts at steep premiums to secure feedstock. Yet each $1,000 per ton hike in lithium carbonate translates to about $100 added per kilowatt-hour of battery capacity, a roughly $12,000 uptick on a 120 kilowatt-hour SUV pack before factoring in gallium-driven semiconductor costs. Legacy OEMs can absorb some of these sticker shocks, but smaller EV startups, Rivian, Lucid, risk production delays or price hikes that undermine their competitive edge. On the aftermarket front, recycled rare earth initiatives and second life battery programs offer a glimmer of relief, but they're still scaling up. In effect, this rare earth chess match will determine which automakers lead the next decade of electrification, and which stall out, unable to deliver on promised price and performance targets. With minerals scarce, supply chain strategies become critical. Let's explore how parts are shuffling and what it means for your driveway. Number 1, supply chain shuffle and your drive ahead. As the dust settles on U.S. tariff cuts and Treasury turmoil, global auto supply routes are doing a full-on lane change. China's recent export bump, up 8% to Europe and a whopping 23% to Southeast Asia, shows manufacturers rerouting parts through Vietnam, Thailand, and beyond to skirt hefty duties. Vietnam alone swallowed $30.2 billion in Chinese auto components in Q1 2025, many relabeled and shipped stateside under more lenient tariffs. That workaround forces U.S. customs into a game of which container is real, while some overseas suppliers quietly slip lower-duty parts into the system. Back home, American component makers without such networks face stiffer competition, putting factory jobs at risk. On the production line, the response is friend-shoring. Ford's new EV truck plant in Tennessee is tapping local module vendors, and Stellantis is doubling down on European battery partners for Ram and Jeep electrics. But building those resilient supply webs takes years and billions in investment, while dealers wrestle with empty lots and delayed deliveries. Shoppers feel the squeeze too. Edmunds reports EV wait times stretching 4 to 8 weeks. And used EV values tick upward as urban drivers hunt for loaners. Service bays are stockpiling critical parts, battery management units, ADAS cameras, engine control modules, anticipating longer repair lead times and higher labor charges. All these shifts bring us to the final verdict. Can the industry adapt, or are we headed for a slowdown? Let's find out. The final lap: debt, duties, and driving into tomorrow. In a matter of weeks, America's financial roller coaster, from a failed $25 billion auction to a 45% tariff rollback, has thrown the auto sector into high-gear adaptation mode. Rising yields mean steeper car payments. Volatile duties inject unpredictability into pricing. Mineral shortages tighten the screws on the EV transition. Yet each shock is also a catalyst. Regionalized supply chains are accelerating, recycling and second-life battery initiatives are gaining traction, and innovative financing solutions are coming to the fore. For buyers, the signal is clear. If you found a reasonable rate, lock in that loan now and consider models built on diversified sourcing. For OEMs and suppliers, the playbook demands collaboration. Invest in U.S. critical mineral production, secure long-term material agreements, and streamline customs compliance to avoid future whiplash. Over to you. How are you adjusting your car buying plans in light of rising interest rates and shifting tariffs? Have you experienced longer wait times or price hikes on EVs or parts recently? What strategies do you think automakers should adopt to keep production and your driveway running smoothly? Share your thoughts and experiences in the comments below. We love hearing your pit stop perspectives. Thanks for riding along with Piston Pundit. Until next time, stay curious, stay informed, and keep those engines humming. You can now check out any of the videos on the screen. There's plenty more to explore.